The NASDAQ has seen its single worst month since 2008. This is terrible for stock investors who are long, of course, and we'll be discussing what to do and what not to do with Gareth Soloway, Chief Market Strategist at InTheMoneyStocks.com. Gareth, welcome back. A lot to discuss today. We've got breaking news coming out of Europe regarding Russian oil. We'll talk about that. You're putting on new trades for the precious metals, so definitely touch on that as well. And, of course, Bitcoin news for the crypto investors out there. Welcome back.
Hey, thanks, David. Lots to talk about. Always fun.
Yeah, both you and I had coffee this morning, so we're going to just rip through this as quickly as possible with as much energy as possible, because that's what the markets are feeling right now. A lot of energy in both directions. Right now, we're kind of stabilizing. I'm talking about the stock markets, of course. A huge drop on Friday, as we saw the S&P 500 drop 3%. The NASDAQ got decimated, of course, that day as well. Now, I want to just zoom out and talk about the broader picture. Yes, this week, or the past week, has been bad for stocks, but it wasn't just last week. This drop started last year. You've been calling for a bear market for quite some time. I don't know if you want to come out on a limb and call this a bear market right now, but what we have seen, Gareth, is since November, a drop in risk assets, both the cryptocurrencies and stocks. The NASDAQ has been falling since November. So what happened since November, Gareth?
So the bottom line is everything changed. And when I say changed, it all comes down to the Federal Reserve. So the Federal Reserve went from a body that was printing. The government was printing. And all of a sudden, we're not getting any new stimulus, no new kind of build back better plans in the government. That's not going to pass. And the Federal Reserve reducing their balance sheet, raising interest rates, stopping QE. And it's basically putting a hard ceiling on the market. The market has no place to go but down to kind of unwind what we've been seeing. So this is kind of why in December, when I talked about how gold would be the best performer in 2022. And so far it has been as we approach getting closer to the midpoint in the year. But bottom line is, this market will have major bounces. The great thing about a market that's not backstopped by the Fed is that there's volatility. So for swing traders and day traders, this is the best market in the world. For investors who are long-term, it's going to be a tough market. There's a lot more downside to go.
You know that old adage, sell in May and go away? Is that going to apply this year? Are you going to be going away, leaving us, Gareth? Are you going to be leaving us in the dark?
No, you know I'd never leave you, David. But don't worry about that. I'm going to be here guiding people through right with you in these interviews. And the bottom line is, I've been warning people to be more cautious, to be more conservative, be more of a trader if you're a trader, otherwise sit on the sidelines or get into something like gold. And I think that's important to understand, folks, is that people always said, don't fight the Fed on the way up, right? Because the Fed was printing money. Yet for some reason, people are fighting the Fed now when they're doing the opposite, and they shouldn't be. So think about that. It's very, very logical. Don't use emotion. You're seeing stocks that are discounted heavily. They're going to get cheaper. Apple's going to go down. Amazon probably goes to 2,000 before it gets a level to buy. So be ready for that.
Talk about being ready. This week on Wednesday, the Fed is going to start their two-day meeting. People are expecting, by people, I mean the markets are expecting a 50 basis point rise. Do you agree with consensus?
Yeah, absolutely. So the Fed has been amazing at just telling the market and reiterating again what they're going to do. So we're going to get a 50 basis point hike. The key is going to be this, right? And this is what the market's looking at. And by the way, we're getting a pause day today in the markets. You'll probably get that again tomorrow because everyone's just waiting for this. And the statement is what's going to make the difference. So what I've been saying to people is from a 1 to 10, the Fed has been talking up the rate hikes and what they're going to do at a 10. They're at the most hawkish that they've been in a long time, if ever. The question is if the market continues to sell or the economy, and we saw GDP last week come in very, very weak, can they come out at a 9 or an 8? So we're still talking hawkish. The Fed's not going dovish. People need to forget about that. But it's the degree of hawkishness that's going to determine where the markets go Wednesday and after Wednesday.
All right, give us a baseline, worst case and best case. So baseline is a 50 basis point expectation. But what about the dot plots? What are people expecting for the remainder of this year and the next? Basically, I want to just get your thoughts on what the Fed could do and announce that could really trigger a sell-off. And on the opposite end of the spectrum, what they could announce that may potentially trigger a bull rally.
Yeah, so I think the worst case for the market would be if the Fed came out at a 10, meaning just as hawkish, as amazingly harsh and hawkish as they've been. And they basically said, hey, listen, no matter what the economy does, no matter what the stock market does, we are going to continue to rip rates higher 8 times this year or so. That would freak the markets out, because again, what the market's concerned about here is that the Fed is slowing the economy. The supply side of things is causing price inflation, which is slowing the economy. Oil prices are high, that's slowing the economy. And the market wants to know that if the economy slows substantially, the Fed will back off a little bit. So if the Fed does not say anything like that, that will scare the markets. If the Fed gives us just that inkling, that little tiny crack in the wall that says, hey, listen, we would potentially back off from 8 rate hikes to 4 or 6 or 5, that would be something that the market would say, all right, the Fed is still around. They're still here to help us just in case. Yes, they have to fight inflation, which is important, but they're not totally leaving us for good.
So your base case scenario is actually just a continuation of what Powell has been saying. In fact, he's been calling for a quickening of Fed tightening at the IMF meeting that he held where he was attending last week. Yeah. So basically you're saying that if nothing changes in the Fed stance in regards to tightening, the market's going to go down.
Yeah, I agree. That's exactly what I'm saying is you're going to get, the markets are prepping for that, and the markets are hoping with this pause day today and tomorrow going into Wednesday that maybe the Fed will show us a reprieve. But the bottom line is the stock market is still way above the pre-COVID highs. The inflation issues are just we're just not seeing inflation coming down right now in any metric. And that is going to make the Fed probably be very, very hawkish and continue to be hawkish. If they can give just a small if they can throw a bone to the market, if you will, by saying, hey, listen, don't worry, guys, if it gets too crazy, if the economy goes into a steep recession, we will back off. Then the markets start to rally and tech could rally. And by the way, the 10-year is bubbling up against 3% today. I do think you are going to get a pullback off this 3% level. In fact, I've been buying the TLT, which is kind of an inverse play where if rates come back down a little bit, in a short-term trade, and this is only a swing trade, TLT would bounce. So I've been accumulating the TLT.
It's just ironic that you're basically saying we need really bad news for good news to happen. Because let's reiterate what you just said. In order for the Fed to pull back or scale back their tightening, we need signs of a recession. I guess great for traders who are long, but that's really not great news overall for the American people.
And I want to reiterate that. That's what's so scary about this scenario is that, yes, that would give a slight positive to the markets in the near term. Yeah. But after a bounce, investors would start to say, okay, but now a recession, yeah, maybe the Fed is a little bit looser and more slightly less hawkish, but now you're going to see a recession cause a slowdown in earnings growth that could get worse and worse. And then that's going to be a pressure on the stock market and these valuations in these stocks. So this is really potentially going to be one of the nastiest storms we have seen in the market, where again, I think that again, you're looking at the NASDAQ potentially being down 40 to 50% over the next 12 months from the highs of last year.
Wait, from the highs of last year, we're already down about, I can't remember the exact percentage, but we're not 40% down, but we're somewhere halfway. So you're saying an additional 20% from here?
Yeah. That's what I think. Yeah. So I think right now we're down about 22, 23%. Right. So I think you go down about 40 to 50% at least within the next 12 months. So it is not going to be a pretty thing. And you're already seeing the cracks, right? I mean, we've seen Facebook collapse. We've seen Netflix collapse. Apple's still holding on, but notice how Apple's earnings were amazing and the stock is still selling off. Notice how Tesla's earnings were amazing and Tesla still ended up selling off after that initial pop on earnings. Those are the signs that tell you big money is exiting from these big names, and it's just the start. And because those names make up such massive percentages of the indexes, that alone can take down the markets. I mean, you could have some of these beaten down plays that are down 90%, hold steady even, probably go down a little, but just those big cap names can take the NASDAQ 100 down another 20%.
Yeah, it's important to note that a lot of these big indices are composed of just tech stocks. So, if one sector, namely the tech sector, goes down, then the whole index gets dragged down. I want to point your attention to something else here. It's occurred to me that, this has occurred to me a while ago, but I'm just reading Elizabeth Warren's tweet from over the weekend. And it just strikes me that not everybody in the government agrees with the viewpoint that the Federal Reserve has been partly responsible for inflation. By that I mean quantitative easing has spurred rising prices. Listen to this tweet. One of the reasons why prices are up, ? Corporations have figured out they can use inflation as cover to not only pass along their own increased costs to consumers, but also to price gouge to boost their profit margins. We need tougher rules to prevent price gouging. If I can do some analysis here, it sounds like Senator Elizabeth Warren is saying that inflation is up because the private sector refuses to lower their prices. In other words, they're artificially propping up their prices. The CPI should be lower, according to some members of government. Should the private sector just be a little more, I guess, compassionate towards consumers? Is that a view that you share?
Well, I mean, this is capitalism, right? I mean, this is the problem is that, if you have a capitalistic society, what you're going to have is that companies, when their prices go up, they're going to say, okay, well, as long as people will still buy it, we're going to raise our price. And this way our profit margins remain the same. Now, what she's saying is that, hey, listen, they should be saying, okay, we're in a very tough spot. Consumers are hurting. So maybe we'll take a cut on the amount of money that we're profiting. And therefore inflation doesn't have as big of a bite. So again, I mean, this is the big battle, right? I mean, which one do you go? Do you go with one side or the other side? My always feeling about it is that there should be some happy medium. And I think most Americans would agree is that, you don't have to be hard-nosed and say, screw everyone on this side. And you don't have to be on this side and say, oh, we're going to totally, wreck the profits of these companies. There's some sort of in between where we should get to. Problem is in politics, there's never an in between, unfortunately.
Yeah. Where I'm going with this is that maybe the government can put some pressure on the Fed to not raise rates because according to their view, I don't know if this is actually what they think or this is just one of the messages they want the public to think they think, but maybe they can put some pressure on the Fed to not raise rates, keep things the way they were, because according to people like Warren, the Fed was not responsible for inflation to begin with. So why bother raising rates? Why not just leave them alone, let the private sector take care of inflation?
So let's be clear. The Fed and the government are absolutely responsible for inflation. I mean, you cannot just print trillions and trillions and expand a balance sheet and pump this much money and basically rescue a market. And that's really what happens is that the Fed throughout time has always been the backstop. So if the markets were to fall, they always cushion it. And what does this do? It makes people want to borrow more money and put it in assets because assets just always go up. There's never any repercussion. There's never any downside. Heck, we saw in 2009, some banks were bailed out and they should have failed and there was no repercussions. And then now they're doing the same sort of lending stuff again. Yeah. So again, bottom line is this is all stems from monetary policy and government overreach in terms of spending. And listen, I'm all for doing certain types of spending where you help people, but it's gotten to the point where there's way too much kind of fluff in every single deal and you got to cut it out and go right to the source. So again, this is where Bitcoin comes in and the future of why I believe in Bitcoin, even though I'm a near-term bear, meaning that I think it's going to go lower. But yeah, I mean, it's absolutely the Federal Reserve that's at the core of this.
Let me ask you this. Who in society actually benefits from higher interest rates? Think about it.
I mean, if higher interest rates are there and it's not inflationary, then retirees, people that are saving money will get a better thing. But the problem is if you're paying 3% or 4% or even 5% and inflation is 8 or 9%, you're still losing money. So again, this is the tricky thing about it. I mean, we all love the idea of causing people to want to save so that they can get a good return in their savings account. But with inflation, what choice do people have?
Yeah. Maybe there's a way for the Federal Reserve to tighten money supply without actually raising interest rates. I'm just putting that thought out there. I'm not saying they won't. They already are going to. But I'm just,
Well, and just selling their bonds. So, I mean, they're getting, as the bonds are rolling off, they're rolling off their balance sheet. I mean, that is a way to tighten monetary supply without raising interest rates. So there are ways to do it. The Fed now is caught between a rock and a hard place, which is in their own doing, which is they've created this scenario where you have massive inflation. And then you have these kind of effects like these black swans where Russia invades or China is now shutting down these cities and it causes more of an inflationary pressure. But the pressure was already there because of what the Federal Reserve was doing. And it's inevitable that you're going to have these black swan events that at some point are going to bubble up. And it wouldn't be as big of a deal if you didn't have all the monetary easing that caused the initial inflation surge.
I think it's also the other way around. The Federal Open Market Committee needs to directly intervene in the bond market to purchase and or sell treasuries to set their interest rates to a certain level. That's how they move rates, right? So if it goes up or down, we can see buying or selling. But you're absolutely right. I mean, perhaps there's other avenues to explore besides controlling just the interest rates. Now, probably the government, Congress on the fiscal side can do things to help with inflation too, right? Have you considered, just as a citizen of the U.S., have you considered whether or not prices of your everyday life could be lower or higher depending on what the government can do?
Well, I mean, you could always get in a situation where the government could set prices and say, hey, you can only charge X amount. But honestly, then that's not healthy either. And then you have companies that say, hey, if we can't turn a profit doing it, we're going to stop producing it. I mean, so it's just, I mean, you have to let the free market be the free market. The problem is, I mean, we think that we live in a free market society, but honestly, we haven't. As long as the Fed had that dual mandate where they've been forced to focus on unemployment back from 1977, it's never been a fully free market. And I do believe that if you had a fully free market, things would be working a lot more smoothly.
Okay, I want to move on from the Fed now. We've already talked about the Fed meeting this week and potential market reactions. Let's talk about what's going on in Europe. Last week, Germany announced that they are no longer opposed to a ban on Russian oil, and they are open to an idea of an embargo. Now, today I'm reading news. The EU is taking this one step further. I'm just going to read a paragraph from today's Wall Street Journal here. The headline of this article is, "The EU prepares ban on Russian oil." Okay, the first paragraph reads, "The European Union is likely to propose ending purchases of Russian crude oil by the 27-country bloc before the end of 2022, and a ban on purchases of Russian refined oil products by year-end, according to two senior diplomats." So let's suppose they go ahead with this ban. Let's just suppose the EU no longer uses Russian oil. We've already seen what happened last week when Germany announced their shift in stance. Previously, they were opposed to a ban. Now they aren't. Oil prices moved up on the news. Now, I think one of the reasons for the switch in stance is because Germany previously was heavily dependent on Russian oil. I think 33% of the supply, a third of their supply came from Russia. Now somehow they've dwindled that down to only 25% of the supply. So they're becoming less reliant on Russian imports. My question to you, Gareth, is suppose the EU goes ahead with this ban, how likely are we going to see a repeat of the late 70s when OPEC instituted an embargo on oil? Now, granted, the situations and the geopolitics back then were very different, but people are sort of starting to see similarities here, right? Can we start to see lineups at the gas station in Europe and across America as well? Can we start to see this ban extended to other parts of the world? Well, what's going to happen? Is this going to be like a domino effect here?
Yeah, so I'm not thinking that it's going to be is ultimately going to see the same issues as what we saw in the 70s. And the main issue here is that Russian oil only makes up about 5% of the total oil. The U.S. now is much more energy independent, so that's going to keep the U.S. from having those long lines here. And bottom line is the charts are telling me that both natural gas and oil are going to go lower. So that's telling again, and charts are very important because what it tells you is that, when you're seeing these headlines and oil's not making a higher high, or natural gas, for instance, we heard about, Russia maybe cutting off the pipelines of natural gas to Poland and some other countries. And the bottom line is the oil charts and the natural gas charts didn't even make higher highs in the near term. Here's your high on oil, lower high, and basically lower high. That is not a bullish sign. It shows you smart money is moving away. Now, if we look at the natural gas chart here, the same thing is going on, right? So basically, you got those headlines, and look at how this high, which was about 2 to 3 weeks ago, even with the headlines recently about natural gas, you're not seeing natural gas make a new high. Now, part of that probably is that we're warming up. The world, again, Europe is starting to warm up. But again, when you see lower highs on more aggressive headlines where the price should actually be making a higher high, that's telling you smart money is starting to unload. And the bottom line is the reason why I don't believe that oil and natural gas are going to make higher highs is because now the global economy, and people are starting to realize this, the global economy is starting to slow due to high oil, due to high inflation, due to Federal Reserve and global central banks hiking rates. And that, again, is going to hurt the demand side, which will keep prices from making new highs.
Okay, so bottom line, are you long or short oil now?
I'm not short oil right now. I am short natural gas.
Okay, so you're short natural gas. Let's move on to the precious metals, because you told me offline that you had made some recent PM trades, in particular silver. Yeah, I'm just seeing you type in silver now. Huge downward move in silver. So what's this trade you made?
Yeah, so silver, I have been accumulating silver on the long side in this lower range here. We've now come back in to basically retest the breakout. You have this upsloping trend line kind of coming right into here. Look at all these red candles on silver. So silver is primed for a bounce. What I love about silver today is that early in the day, it was down sharply, and it's now coming back not too far from the flat line. So again, way oversold near term, right back to what I would call the retrace where we were consolidating here. I think silver is going to start to take off. And gold, I think the last time we talked, I said I was waiting to buy gold till it got back to about 1850 on spot gold. Well, if we take a look at gold today, it finally did dip. The low today was right around 1850. It's now in my buy range, right in this 1850 to 1825 range. And these are the retraces that as a metals investor that I've been waiting for. So again, I am in silver. I haven't picked up any gold yet, but I'm looking to buy gold if it dips just a little bit more as well.
What if it doesn't dip to that level? Are you going to stay on the sidelines?
Yeah, so as a trader, I'm very disciplined where it's my level or the highway, right? So again, there's always another trade, and this is one of the great educational things to always remember is that I've never missed a trade and said, "Oh man, that was the last trade I ever got in my entire life." So if you miss a level, you find your level, you're disciplined enough to stick at your level. If it gets filled, it gets filled. If not, you say, "Okay, well, there'll be something to trade tomorrow instead."
Okay, interesting. Now, just from a technical perspective, suppose gold doesn't hit your downside support level. What are you expecting it to do? Is that in your view a bearish or bullish signal?
Yeah, so I mean, really, it should. If it doesn't hit and it starts to trade up, that's just a bullish sign. I mean, there's just so much buying pressure on gold that if it doesn't come down and go in this area just a little below 1850, which is my buy zone, then yeah, it would just tell you that people are they can't even wait for the levels. Even big money is rushing in. So in general, levels will hit, but occasionally they do miss by a hair, and that's just the nature of the buying volume that comes in. So yeah, it's always possible. Ultimately, I think gold is going to go way, way higher. I'm talking more on a swing trade. Now, to be clear, I do own a lot of physical gold and a lot of physical silver. I always hold that. I'm not trading that because it's physical. There's too much cost to trading it. But again, when we're talking about a swing trade on gold, I'm looking at this area, 1850 to 1825.
What do you swing trade? Just out of curiosity, an ETF, futures? What do you do? Gold stocks?
Yeah, I do things like the GLD for gold, okay. GDX for gold, those type of, or SLV for silver. That's what I've been buying, the SLV.
And what's your upside target for gold and silver?
So time frame is really important here on gold. I think within the next 6 weeks, we probably do trade back up to 2070, which was that previous high. I think by end of year, you could be looking at 24 to 2500 on gold. On silver, the big level to watch is basically back to this high here, which was the Wall Street bets pump here and the previous high. So you're looking around 30. And I think by end of year, you have a decent shot of getting back to 30 or maybe just in early 2023.
Okay, so you are long silver and gold. At what point then, just one last question on preamps before we move on to Bitcoin. At what point then, Gareth, would you say that there's an inflection point down to a more, I guess, bearish cycle? Because right now you're expecting it to retrace to a certain support level, but that's still a kind of a bullish thesis here. You're waiting for it to touch and then go long. But at what point would you say, yeah, these charts are telling me that prices are going to be sustained on a downward momentum level? Or basis? How would you make that assessment?
So you're right on that. And as a trader, you always have to look at both sides of the trade, right? You have to look at, okay, where is it going to go if I'm right, but also where is it going to go if I'm wrong? So again, to be clear, this is your buy range right here, which is what we call a retrace to the scene of the crime, a retrace to the breakout. So you had a gold breakout. It's now got it should retrace into this 1850, 1825 level. If by chance it starts to break lower, and it comes down here, I would want to see it hold this 1800 level. Trades below 1800, then you have the potential of going down maybe as low as 1680 or so. So again, this is becoming a huge, huge level. I do expect it to hold. And again, if you just think logically with inflation, with the concerns about the global economy, where are people going to hide when they're de-risking? It's generally going to be the metals and mainly gold. But again, always a chance you could be wrong. So understand what levels it needs to hold and where it could go if it breaks.
Okay. That makes sense. Now, Gareth, let's move on to Bitcoin. We were talking offline about the volatility profile of Bitcoin. It seems to me that cryptos are not making front and center headlines every single day like they were last year, simply because the prices have been kind of rage bound. What's going on here? Are you Are you still eyeing Bitcoin with the same, I guess, medium-term pessimism as you have in the last couple of quarters? I've spoken to you about this.
Yes, and thank you for making the distinction of medium term, because long term, I love Bitcoin, I love cryptocurrency, but medium term, see that this channel right here, I mean, this is a bear flag channel, and you're now hammering on the lower end of it. You just kind of hit it, you just bouncing a little bit.
Can you describe why that's a bear flag channel? Because I'm looking at this channel and it seems to be tilting upwards, right? Is it not signaling a move towards higher highs there?
Yeah, and this is what's fascinating is that's the way average investors, like retail investors, look at it. They say, "Oh, but it's making higher lows and higher highs. Isn't that bullish?" In fact, if you look at 100 of these or 1,000 of these patterns, this is what's referred to as a bear flag. And what's interesting is you can see the opposite thing right over here, where you actually remember back last year, you actually were making the opposite pattern and look at the direction it went. So when you're angling down, it's making investors feel more insecure, making investors feel more bearish, and therefore price is going to go the opposite of retail investors and going to go up usually. When you go this way, this is luring investors in. They're trying to con you in, not con literally, but it's trying to fake you out in terms of the price action. And this one breaks down. So again, people are saying, well, isn't this the same as this? And the answer is no, it's not. This was a down sloping channel. It breaks up. Upsloping channels tend to break down.
Okay. I mean, surely you can find exceptions to this, but yeah, sure. That's all right.
And
that's
just
interesting.
And you're right about that, David. Let me just to be clear. Everything is probabilities, right? So if you looked at 100 of this pattern, 80 of them would break down, 20 of them would fail and break up, right? So it's probabilities.
Yeah, and so let's talk about targets then. I remember talking to you about Bitcoin. Your band or your range of upside and downside floors and support levels have become narrower and narrower as time progressed. There was a point in time, I think, in the past when your upside target was $10,000 to $20,000 above your downside, and now it's a couple $100 or something like that. So what's your range now?
So just to be clear, I mean, when you're talking about trading the range, so short, long, I mean, that's where you get into these really tight levels. But if we're talking medium term, let's talk 6-12 months out when I think Bitcoin has a good shot of bottoming out. I mean, we're talking about some major downside. I'm still in the camp that you're likely headed to 20,000 or below as an ultimate target. Again, 20,000 would be the 2017 high. I think you're seeing more and more the realization that the stock market is weakening and money's being pulled out. It's a de-risking going on, which is very, very bad for Bitcoin since Bitcoin trades off of the NASDAQ essentially with de-risking. And you have to see this washout. I've said this from day one, going back to, our in-person interview in Dubai last October, that you have to see this full washout. You almost have 20,000 cryptocurrencies. There should only be like 20. And so you have to see this .com type flush out where a lot of these go away. And then ultimately from the dust will rise the best of breed, very Darwinian in that, and they will succeed and they will flourish, and Bitcoin will see 500,000 and we'll see $1 million. So ultimately midterms, next 6 to 12 months, 20,000 at minimum, maybe lower. But again, that is my midterm 12 month target.
Say that again.
Midterm 6 to 12 month target, 20,000 or sub.
Okay, so let's sum up for the audience today's outlook. 40% lower on the NASDAQ from its previous high in November. You're looking at $2,400 gold and $20,000 Bitcoin in the next 6 months. Is that correct?
For Bitcoin, 6 to 12, hard to pinpoint. I'm using past cycles. It took 12 to 18 months for Bitcoin to bottom out in previous cycles. We're already 6 months in from the high, so 6 to 12.
Yeah, but so basically by the end of the next 12-month cycle, we could at some point see your floor of 20K. And again, and over the next 12 months, we can see 2,400 gold and the 40% retracement of the NASDAQ. That's your summary.
I would be surprised if it doesn't happen.
Okay, what about oil again? What's your summary for oil?
Oil by midterm elections, 75 or below.
So you're basically bearish risk assets and cyclical assets.
Yeah.
Okay. Well, thank you for your update, Gareth. I'm sorry you couldn't bring better news for risk asset investors, but hopefully, or maybe things will change the next couple of months. Who knows? But we'll have you on regularly to update the audience.
Absolutely, David. And if there's one thing I like to say to people is like, when I was talking bearish on Bitcoin at 65, I hope at least in the very least, I saved some people some heartache and some hardships by hopefully making them be a little bit more conservative. So that's the key, is that, there's always a trade, but you want to be conservative when the Fed is telling you to be conservative when they're hiking rates.
I have to share the story. This is nothing against your cause or anything. It's just I've been stopped by people on the street, literally in Montreal, saying, "Oh, I recognize you. You're from Kitco. By the way, your Gareth Soloway interviews. I'm still waiting for that 20K. You know how much I've missed in terms of gains just waiting on the sidelines for 20K?" And I say, "Well, listen, I'll have Gareth on and we'll update you."
Considering when they've been asking for that, it was at 65. Then they've saved themselves a lot of money, right?
That's true. Good point, Gareth. I'll speak to you next time. Thanks so much.
Thanks so much. Take care.
And thank you for watching Kitco News. I'm David Lin.